Financial Retrospective and the 2026 Strategic Inflection. The fiscal year 2025 for Novo Nordisk concluded with reported sales of DKK 309,064 million, a 10% increase at constant exchange rates, CER, that initially appeared to signal continued momentum. However, a granular dissection of these results reveals the early onset of the pricing and competitive pressures that would come to dominate the 2026 outlook. While sales in obesity care surged by 31% at CER, reaching DKK 82,347 million, the core diabetes care segment remained stagnant in reported Danish kroner, growing only 4% at CER. This stagnation is particularly notable given the 104% volume growth in the global branded GLP-1 obesity market, suggesting that while the market is expanding at an extraordinary pace, Novo Nordisk's relative share and pricing power are under sustained duress. The compression of the gross margin from 84.7% in 2024 to 81% in 2025 is a critical indicator of the structural shifts occurring within the company's cost base. This decline was primarily driven by the integration of the 3 manufacturing sites acquired from Catalent, significant one-off restructuring costs totaling approximately DKK $8 billion, and the aggressive expansion of internal active pharmaceutical ingredient API production capacity. These investments, while necessary to secure a long-term supply, have introduced a period of margin volatility that management expects to persist through 2026. The guidance issued for 2026 has introduced a new level of caution to the market. Novo Nordisk has projected adjusted sales and operating profit to decline between 5% and 13% at CER. This guidance reflects a rebasing of the company's revenue model in the United States, where the introduction of the Most Favored Nations MFN agreement and the TrumpRx.gov platform have forced a dramatic reduction in realized prices. Furthermore, the depreciation of the US dollar against the Danish krone is expected to further erode reported growth by an additional 3 to 5 percentage points. The bull case: Moats, resilience, and value. The bullish thesis for Novo Nordisk in March 2026 is predicated on the belief that the market has overcorrected in response to the 2026 guidance, creating a valuation that fails to account for the company's massive infrastructure moat and its expanding clinical indications. This perspective views the current price-to-earnings (PE) ratio, which has fallen to approximately 10.02x to 10.62x, as a significant discount for a market leader with a 61.10% return on equity and a robust dividend yield of nearly 5%. Infrastructure moat and vertical integration. A primary pillar of the bull case is the physical moat, established through Novo Nordisk's unprecedented investment in manufacturing. By March 2026, the company had committed to a capital expenditure (PP&E) trajectory exceeding DKK 55 billion to 60 billion annually. This includes the $11 billion acquisition of the 3 Catalent fill-finish sites, which are now being integrated into the GLP-1 production network. The strategic relevance of these sites, located in Anagni, Bloomington, and Brussels, cannot be overstated. In a market where supply was the primary constraint for 3 years, owning the end-to-end manufacturing process allows Novo Nordisk to optimize its cost of goods sold, COGS, over the long term, even as unit prices decline. This is complemented by the $4.1 billion expansion in Clayton, North Carolina, which will add 1.4 million square feet of aseptic manufacturing space by 2027-2029. The Athlone investment is particularly significant for the bull case, as it enhances the company's ability to manufacture oral GLP-1 products, which management believes will eventually represent a substantial portion of the total market. By controlling its own tabling and fill-finish facilities, Novo Nordisk reduces its reliance on third-party contract development and manufacturing organizations, CDMOs, insulating itself from the supply disruptions that have historically benefited rivals like Eli Lilly.
Clinical expansion and the cardio-kidney metabolic (CKM) paradigm. The bull case also rests on the transformation of semaglutide from a weight loss drug into a multi-indication standard of care therapy for cardio-kidney metabolic syndrome. The success of the FLOW and SOUL trials has provided Novo Nordisk with a unique clinical profile that is difficult for generic entrants or even newer competitors to replicate quickly. The FLOW trial demonstrated that 1 milligram of semaglutide reduced the risk of major kidney disease events, kidney failure, and cardiovascular death by 24% in adults with type 2 diabetes and chronic kidney disease. Crucially, the kidney protection was found to be independent of the degree of weight loss achieved, suggesting a direct organ protective mechanism. This clinical differentiation is reinforced by the SOUL trial, which showed that oral semaglutide, Rybelsus, reduced MACE risk by 14%. The sub-analysis of SOUL further indicated that oral semaglutide was particularly effective in patients with heart failure with preserved ejection fraction, HFpEF, reducing the risk of a composite heart failure outcome by 41%. These data points suggest that Novo Nordisk can defend its market share by focusing on high-risk medical populations that are less sensitive to the aesthetic lifestyle trends of the broader obesity market.
Valuation and the deep value entry point. From a quantitative perspective, the bullish argument highlights that NVO is trading at a PE multiple of 10x, which is 62% below its 10-year historical average of 26.5x. At the same time, its chief rival, Eli Lilly, trades at nearly 40x earnings. This divergence suggests that the market has priced in a worst-case scenario for Novo Nordisk while pricing in perfection for Lilly. However, Novo Nordisk's cash flow remains formidable. The company expects free cash flow between $35 billion and $45 billion in 2026, even after accounting for massive capital investments. Furthermore, the DKK 15 billion share buyback program and the consistent dividend policy provide a solid floor for the stock price. Bulls argue that as the 2026 pricing rebasing becomes the new baseline, the company's ability to drive volume growth, which increased by 44% in international operations during 2025, will lead to a valuation recovery. The bear case: structural erosion and competitive displacement. The bearish thesis for Novo Nordisk in March 2026 focuses on the collapse of the U.S. pharmaceutical pricing model, the clinical failure of next-generation candidates, and the impending generic incursion in high-growth international markets. From this perspective, the rebasing of 2026 is not a one-time event, but the beginning of a long-term structural decline in margins as the GLP-1 class becomes increasingly commoditized. The collapse of U.S. pricing power. The primary driver of the bear case is the unprecedented intervention by the U.S. government to lower the cost of obesity and diabetes medications. The launch of TrumpRx.gov and the enforcement of Most Favored Nations (MFN) pricing have stripped Novo Nordisk of its most lucrative revenue stream. As of early 2026, the realized price for Wegovy in the U.S. has fallen from over $1,300 to an average of $350, with some channels offering it as low as $149 for cash-paying patients. This pricing collapse is exacerbated by the balance and bridge models introduced by the Centers for Medicare and Medicaid Services, CMS. Under these models, Medicare beneficiaries gain access to obesity medications with a capped copayment of $50 per month, which requires manufacturers to provide massive discounts to the federal government. The bear case argues that volume growth cannot possibly compensate for a 50 to 75% reduction in net price per unit, especially as gross margins are already being squeezed by high manufacturing and transformation costs. Clinical stagnation and the failure of CagriSema. A second pillar of the bear case is the recent failure of Novo Nordisk's next-generation pipeline to deliver superior efficacy over existing competitors. The highly anticipated REDEFINED 4 head-to-head trial between CagriSema and Eli Lilly's Zepbound tirzepatide was a definitive loss for Novo Nordisk. CagriSema, a combination of semaglutide and the amylin analog cagrilintide, failed to meet its primary endpoint of non-inferiority on weight loss.
At 84 weeks, patients on CagriSema achieved a weight loss of 23.0%, while those on Zepbound achieved 25.5%. This 2.5 percentage point gap is clinically significant and effectively positions CagriSema as an also-ran in the high-efficacy injectable market. Furthermore, Eli Lilly's triple agonist, retatrutide, has already demonstrated average weight losses of up to 28.7% in Phase 3 trials, suggesting that Novo Nordisk is losing the efficacy arms race. The disappointment in the obesity pipeline was compounded by the total failure of the EVOKE Phase 3 trials in early Alzheimer's disease. Oral semaglutide failed to demonstrate any clinical benefit for cognition or function, leading Novo Nordisk to terminate the program and discontinue the one-year extension period. This removes a multi-billion-dollar blue sky opportunity from the valuation and forces the company to rely exclusively on the increasingly price-sensitive metabolic and cardiovascular markets.
The patent cliff and generic incursion. The date March 20, 2026 marked a structural inflection point for Novo Nordisk's international business, as core patents for the semaglutide molecule expired in China, India, and Brazil. These markets represent a quarter of the world's obese population and have been significant drivers of Novo's volume growth. In India, the expiration has opened the door for at least 50 generic brands to enter the market, with major manufacturers like Sun Pharma, Dr. Reddy's, and Zydus Life Sciences launching biosimilar semaglutide for as little as $14 per month. In China, 16 biosimilars are already in development, threatening Novo Nordisk's market share in a region where it previously held a dominant position. The bear case posits that as these low-cost generics penetrate international markets, they will inevitably create gray market pressure in the United States and Europe. Patients who cannot afford even the discounted Trump RX prices may turn to imported biosimilars or compounded versions, further eroding Novo Nordisk's branded volumes.
Finally, the bear case highlights the operational strain on Novo Nordisk. To manage the decline in profitability, the company has undertaken a massive transformation program involving 9,000 job cuts and a DKK 8 billion restructuring charge. The bear thesis suggests that an organization that has more than doubled its sales since 2019 is now suffering from scaling fatigue. Integrating the Catalan sites, managing the shift to oral production in Ireland, and defending against a wave of generic entrants requires a level of focus that may be compromised by the ongoing headcount reductions and management turnover. The competitive landscape, the rise of the Triple G and monthly dosing. The rivalry between Novo Nordisk and Eli Lilly has matured into a tactical battle over dosing frequency and the Triple G, GLP-1, GIP, glucagon mechanism. While Novo Nordisk has banked on CagriSema, Eli Lilly has achieved a $1 trillion valuation by demonstrating superior efficacy and securing a strong pipeline in the oral and triple agonist segments.
Lilly's Zepbound took home $13.5 billion in 2025, exceeding Wegovy's $12.5 billion, and currently holds a 60% share of the U.S. GLP-1 market. The bear case for Novo is strengthened by the fact that Lilly is expected to launch its own oral GLP-1, orforglipron, by mid-April 2026. Orforglipron has already shown superior glycemic and weight loss efficacy compared to oral semaglutide in head-to-head trials, threatening Novo's current leadership in the pill form weight loss market. Amgen's MariTide represents a particularly potent threat to Novo Nordisk's injectable franchise. By offering monthly or potentially even quarterly dosing with weight loss results comparable to Wegovy, Amgen addresses the treatment fatigue associated with weekly injections. Amgen CEO Robert Bradway noted that MariTide stands alone in offering high efficacy at extended intervals, which could become a decisive factor for payers and patients alike.
Strategic manufacturing, scaling the in-house network. The operational success of Novo Nordisk in the coming years will be defined by its ability to execute on its massive DKK $60 billion annual capital expenditure program. This investment is strategically distributed across several key global hubs, each serving a specific role in the company's transition to a vertically integrated manufacturer. The North Carolina hub, Clayton and Durham. The $4.1 billion investment in Clayton, North Carolina, effectively doubles the company's square footage in the Research Triangle region. The primary objective of this site is to provide a dedicated, high-volume source of injectable medicines for the U.S. market, reducing the company's reliance on European imports and external CDMOs. The European expansion, Denmark, France, and Ireland. In Denmark, Novo continues to expand its Kalundborg site, investing $6 billion into API production. This is complemented by an $8.5 billion investment in Odense for rare disease and finished production. In Ireland, the $432 million expansion in Athlone is critical for the oral GLP-1 strategy. providing the necessary tableting capacity to meet the expected surge in demand for the Wegovy pill.
These facilities are designed with a modular and flexible architecture, allowing Novo Nordisk to pivot production between different molecules as the clinical landscape evolves. However, the DKK 55 billion to 60 billion in annual capex also represents a significant cash flow drain during a period of declining sales growth. Conclusion. The bull case rests on the manufacturing strategy, a value proposition at 10x earnings, and a clinical label that extends semaglutide into cardio-kidney metabolic standard of care. This perspective views the 2026 guidance as a necessary and perhaps overly conservative rebasing of a fundamentally healthy high ROE business that will benefit from massive volume expansion as prices fall. The bear case, by contrast, identifies a perfect storm of structural pricing collapse in the US, a pipeline that has failed to maintain its efficacy lead, and a global patent cliff that will commoditize the GLP-1 market. This view argues that the organizational strain of multi-billion-dollar capex programs and simultaneous workforce reductions will prevent Novo Nordisk from defending its market position against more nimble innovators like Amgen or Viking and a dominant rival in Eli Lilly.